Visa and Mastercard currently been down 20% in the last few weeks. This is the stock analysis to check whether they're still a good investment, and I'm Dale from the Investment Journey. I hope you enjoy the following presentation. If you like the video, please like it and comment and subscribe to the channel for more stuff. So, as with all these things, this isn't investment advice, it's for education and information purposes only. Full disclaimer at the end. So what we're going to go through today is look at the overall electronic processing market, look at the durable competitive advantages of Visa and Mastercard, take a look at their intrinsic valuations, and then compare the two head-on, Visa versus Mastercard. What are the strengths and weaknesses? When we look at the overall sheet from the last global financial crisis, we can see 1,000%, so a 10-bagger for both of these stocks. So they've performed extremely well, outperformed much of the financial industry, as there's a recognition that payment processing doesn't have some of the risk that banks do, where they're actually issuing loans. So we're going to look in detail at this, and let's move. Looking at the market overall, we can see the macro trend of digitization of money, payments and commerce, which has been running for some time now, with a global compound growth rate of 6% per year, and that's combining both the developed and developing world. We can see the growth rate in LATAM, Africa and APAC is higher than it is in Europe and North America. And we can forecast based on this McKinsey report that growth is still going to continue. Looking at like a low-level aspect, in some new corporate ventures, some new retail and stuff like that. There's actually a move in certain parts of America where they're no longer accepting cash as a payment, and it's purely electronic payment, which kind of shows the direction of travel. Whereas if you think about India and other developing countries, cash is still king, and the market penetration of electronic payments overall is a fraction. It's 10 or 15% of the entire market, which gives still quite some room to grow. On screen is a graphic highlighting the market share of the electronic payment card schemes. UnionPay is the dominant player in China and is focused mainly domestically. In the rest of the world, this leaves Visa and Mastercard as a de facto duopoly. And when we look into the US, we see that Visa's got 65% market share. 61% market share. Mastercard's got 25%, and then we've got Amex, which is in distant third and 11%. And it's even more pronounced in Europe, with Visa and Mastercard accounting for over 95% of all the card transactions electronically. So these really have a duopoly on the market, and they've become intrinsic to banks, to consumers and to merchants, which puts them in a very strong position. So what can move them and what has put them in that place so far? So here we're going to deep dive into the investment thesis, and this is mainly driven by their durable competitive advantages, otherwise known as a moat, as per the medieval castle analogy. A big wide moat is defensive against attack from new invaders coming. So what are those defense mechanisms that these companies have got? They've got a huge network effect. They've got a large scale of acceptance and use for consumers. So consumers don't need to ask whether they're even accepted anymore. And it's anticipated that they're accepted throughout many countries. What that means, therefore, is the rate of use is very high. Consumer confidence is very high, and that network effect means that all merchants really would like to be on the network to benefit from the widest possible customer base, and then that flows nicely into the switching moat. Consumers don't pay a penny directly for Mastercard or Visa. The transaction costs are actually paid for by the merchant. So if you have a high degree of acceptance and the payment processing is done effectively and efficiently with no fuss from a consumer perspective, and you're not paying for it, you don't really have a rationale to switch, and that reinforces the positive network effect through a lack of switching. And then if we look at it from the merchant perspective, the fact that the network is so big means the incentive to switch is quite low, and the transaction costs are relatively small. It's about 0.2% of each transaction. So we can see there that will it make a huge difference to the profitability of a merchant to move from Mastercard or Visa payment network onto a new payment network by a new player? What's the benefit to them versus what's the risk of losing access to all the consumers? So switching mode is absolutely unbelievable. And then we come on to reputation and brand. So if we talk about reputation first, when you're talking about money transactions, the primary let's say strength that you want to achieve is a high degree of trust. Trust to your transaction will go through first time, that your money won't be lost, that the payee will be able to pay instantaneously, and the receiver, so the merchant, will get paid, and there won't be any complications in that process taking place. And Visa and Mastercard, of course, have got a really strong track record of that, and a very robust network which is compliant with all the local legislation, government regulations, international money markets. It's already linked in with all of the systems that the banks use, that the merchants use, and that the consumers use. And so the reputation and the brand loyalty that attracts is very strong. And then finally, cost and pricing. So if you're a new prospective electronic payment network and you're trying to break down the duopoly, how much is it going to cost to get the technology right, to meet all the legislative requirements, and how long will it take? It's a really massive hurdles to overcome, and then you've got to incentivize people to actually want to change. And at the moment, based on the price of the transactions, it's not necessarily a huge advantage to most organizations to make that move. So when we combine these four things together, it's a very powerful lever for the companies to stay in their position. We hear a lot of talk about PayPal. We heard a lot of talk about Apple Pay when it came out. These systems actually use the electronic networks of Visa and Mastercard, so that they're like another layer built on top of the existing system which sits on Visa and Mastercard, and so that really tells me that if the might of Apple chose not to compete, rather to align themselves and create a system which worked with these companies, well, with Mastercard, rather than to compete directly against them, that tells me that even the biggest tech companies in the world don't necessarily want to disrupt the market, which is quite powerful for long-term investor. So let's get down to valuation here. The actual price for Visa and Mastercard's come down substantially. They're up. Mastercard was up at $344 in the start of or middle of February, around the 20th of Feb, and Visa was up above 200. So I did a discount cash flow analysis. I haven't got the full calculation here, but basically my main metrics were required rate of return 10%. Then I used all of the debt figures from the two companies, what their cost of debt is, what their the tax rates effective were for the companies, and that churned out a DCF, intrinsic valuation, shown in the slide there, 221 and 384 respectively. And then for a company, I normally would like to see a 50% margin of safety, but because these two companies are so embedded in those durable competitive advantages are so big, I'm basically willing to accept a 30% discount on my DCF. So that gives me my own personal target valuations, of $155 for Visa and $269 for Mastercard. And what's interesting is, since those highs in February caused by the coronavirus, there's been a drop of 20% in these two stock prices, which has actually put Mastercard on sale at the moment, and Visa getting close to my margin of safety target price. What's quite interesting is, in the few days since I started to make this investigation, and I originally posted my blog then, these have just got closer and closer and actually touched my margin of safety valuation. And whilst I would accept a 30% discount on my margin of safety calculation, I actually believe these will go lower. I don't think the full extent of the coronavirus is priced in, and we could really see an attractive entry point to these companies. And to be honest, I thought from the 10x growth that we've seen in the price of the stock, I thought I'd actually lost the opportunity to invest in these two companies, although I've always admired them from a stock perspective as something I'd like to own. I think I might get the opportunity to come in at a good price point. So I'm just looking for that, and I'm just trying to wait to find the right optimal time to enter. And then finally, let's just do a side-by-side comparison. Visa or Mastercard, what's the difference? What's the benefits? So Visa has a higher market share overall. It has improved margins compared to Mastercard. It's stronger in some of the developed countries like the US and UK. It spends less on advertisement and development costs, which results in the higher margins. So if you're wanting the current number one player with good margins, then Visa is basically the pick. Mastercard is having faster growth. It's got more exposure to developing markets. It's got lower margins, but they're still strong. We're still talking about margins greater than 50% here. So they're fantastic, in the top quartile of all industries in all sectors on the S&P 500. And they've really been working hard on fintech and creating an edge in developing and working with fintech partners. They've got Apple Pay, which is obviously a massive bonus for them. Although I would say that Visa making multi-billion pound acquisitions and investments in the fintech space as well. So both of them are not resting on the laurels. And what I find really interesting, and the last point I'd like to make is, these two companies could destroy each other with a price war, but they've got an interesting way in which they're competing. They don't seem to be competing on price. They're relatively stable on that front, and that's probably why the margins are not being eroded. What they're actually doing is they're competing on market share and new markets and new technology. So there's a really intense competition between the two companies, but not in a destructive way. And I think that's probably only a duopoly really could have that luxury. If there was more players in the market, you would be forced to compete on price as well. But they're not really at the moment. Certainly that's my perspective. They're just competing in all other domains. So question left with, which do I prefer? I actually would like to take both of them into a portfolio position. My normal position is around 5%. I'd like to take about 2.5% of each company into a portfolio at the right price level in order to capture the benefits that both companies bring. If I was really forced to pick on the long term, I would probably go with Mastercard, because I think the exposure to the developing markets gives them a better long-term view from an investment perspective, even though I can't rule out Visa being really an outstanding company as well. So that's really to conclude the presentation. I hope you enjoyed the quick video here, and if you enjoyed the video, like, comment, subscribe to the channel, and visit the blog below. Finally, I'll just leave you with a disclaimer, and you can read this at your leisure. Good luck, and speak to you at the next video. Thank you. Bye.